Hey everyone. All right, we're going to get started today. And thanks so much for tuning in via audio and also those of you who are on video. Today, we're going to tackle the um, topic demystifying capital returns in an apartment syndication or just in general real estate syndication. So just a quick intro. For those of you who don't know me, my name is Suja, and I do this series every week to really help people who are interested in real estate syndications get comfortable and confident with the terminology and the lexicon and how things actually work in these deals. And so it's it's a big hurdle to get comfortable with these types of deals. And so I'm really excited to just have everybody here that wants to learn about that. So this deal is this call is for you if perhaps you've tried to invest in syndications before but got cold feet, or if you have invested in a syndication before but maybe felt like it was a mistake, or if just in general you feel overwhelmed by all of the information out there and want to understand it better. And today, we're going to cover, as I said, demystifying the capital stack, one of the biggest myths that people have when it comes to passive investing. And yeah, so the biggest myth, and I always go over this because I think it's just, and it comes up repeatedly. One of the biggest myths that people tell themselves is that I won't make that high of a return. And if you've heard me before, you know that I'm often talking about return on time. So there's return on investment, but there's also return on time. And I've done active investing before. I own real estate that I manage and that I've had to find the deals and make it happen. And while that's very satisfying on one level, I also really enjoy having a passive portfolio where I'm not responsible for the day-to-day operations. I'm not responsible for how making sure that we have tenants and that they're paying, and that whether I have to fix a dryer or a laundry machine or a microwave handle. There's just like endless things that break on properties. And when I'm a passive investor, I don't have to do any of that. So I just think that's such a powerful part of it. And also compared to the stock market. So in my opinion, I can't win in the stock market every year. I still have a stock market portfolio, but a lot of wealthy people keep a huge portion of their holdings in real estate. And there's a reason for that. It's because it's stable and steady and it's not volatile. And so one of the reasons why I liked real estate as well. So my story, I'm Sujata Shyam. I founded Lux Capital in 2020, and I have a background working for institutional equity providers who were investing in multi-million-dollar apartment deals. So I come from an institutional background, and at the time I didn't realize that private investors could make money in this space too. And I had no mentors at the banks, and it just wasn't, in my opinion, a very entrepreneurial environment. As much as I liked the people there, I wasn't surrounded by people who wanted to grow their own real estate portfolios. And it took me a while. I figured out that, the way that people are building their real estate portfolios is through syndications that individual investors can invest in. And this world is changing rapidly. It's a really exciting time with the way that the laws have changed in 2012. And the laws are just continuing to actually get more favorable. The SEC continues, like last year, they released a couple of exciting things that happened. Like, for example, they expanded the definition of an accredited investor. And they also, for example, they allowed our verification of accreditation to last for 5 years rather than 90 days, which is just a little thing that actually helps make these deals easier to do. And so the direction is going in expanding access to these types of high quality real estate transactions. And at the same time, you got to be careful, right? And so that's why I'm here. I'm focused on downside protection and want to offer just the best, highest quality deals to myself, my family. We always invest in every single deal. And then also the education piece. So fast forward, we've got over 1,000 verified investors, over 40% repeat investors. And here's just some photos from the last year. And yeah, we'll be doing a bunch of videos. Some of these have already been done, and you can go back and look at them. But today we're going to focus on the stack and what is it, why it's important, and how it impacts you. So before we get started, this is for education purpose only. I'm not a tax attorney or I'm not a tax accountant or an attorney, and so you should definitely consult your team, but I'm here to ask questions. And if I can't answer that question, I will let you know. So feel free to ask any questions that you want. Okay, so let's get into it. The waterfall. So the waterfall determines who, how, and when a limited partner or a general partner gets paid in a apartment or, self-storage or senior housing, and in general, a real estate syndication. And so the waterfall is essentially, we're going to talk about the capital stack, and you and I are investors and general partners. We're partners in the deal. And so the deal itself has expenses, which it has to pay. And then we get paid from, the excess cash flow. And, there's more complications to that, which we're going to go over in depth today. That's kind of the whole point of today's, but just so you know, so there's the property expenses, and then we've got to pay our financiers. And as a limited partner, we are in a lower position in the waterfall, but we also have the higher potential for profit. So as an investor, you want to understand where you stand in the capital stack, because it's going to change from deal to deal. Every single deal is going to have a different capital stack and waterfall structure. And over time, you'll start to understand what to look for, but we're going to get started with that today. You got to make sure that in every single deal you have read the PPM, and also, it should be in the deal OM as well. But make sure you read the PPM, because that's really where the rubber hits the road, and that's really what you're going to need to focus on. So a couple notes. All partners are in an equity position. And what do we mean by partners? So the general partners and the limited partners. So the general partners are the sponsors of the deal, and in my case, the sponsors of the fund. And then the limited partners are the partners who have are the partners who do not have liability in the deal, and they also don't have they don't have liability except for the money that they put in, and they also do not have responsibilities for the day-to-day operation. So they have limited responsibilities, limited liabilities as well. And so all of us, you and me and the sponsors, we're all in equity positions. And we come behind all expenses, fees, and debt. So expenses being property taxes and utilities and repairs and et cetera. Fees, that's something that, is important to understand. So fees are expenses to the property, and sometimes those fees get paid to the general partners or the sponsors. And so, in the next week, we're going to go over the fees that you'll encounter, but just in brief, some of those might be the acquisition fee, the asset management fee. Sometimes there's a disposition fee, or, there's all types of fees that can be charged. And some of those are charged are given to the sponsor from the cash flow of the property. And that is because the sponsor also needs to keep the lights on, needs to pay for legal expenses, and needs to be able to, continue to, to have a livelihood while they're getting these deals done. So there are some fees, and there's also debt. And so the debt also comes before equity. After that, then we get to distributable cash flow, and the distributable cash flow is what goes to the limited partners and the general partners. Okay, so let's go to the next slide. So this is why is this relevant? So the cash on cash return is going to be, your cash on cash return is going to be affected by the waterfall. And so just for those of you who just for review, cash on cash return is the return that you're getting every single year of the hold period. So are you getting 3% returns? Are you getting 7% returns? Does it fluctuate? And then there's also an average. So cash on cash return is the return that you're getting throughout the life of the hold period. So the waterfall is going to affect your cash on cash return. Number two, it also affects your IRR. And IRR is a measure that reflects the overall profitability of the deal. And it takes into account the time value of money, which is one of the most important concepts in finance, is the time value of money. And so IRR is a really wonderful metric to understand, to compare apples to apples deals and their profitability, because different deals are going to have different timelines. And you want to know how fast your money is turning over, which brings me to velocity. So IRR and velocity are kind of related. So how soon are you going to get your money back? Because the sooner you get your money back, the sooner you can reinvest it. And as real estate investors, all of us here are real estate investors, we want to free up our liquid capital as quickly as possible so that we can put it into the next deal, because we understand the benefit, the time value of money, and we also understand how losses can be used. And every time you make a new investment, there's more losses, which can amplify the time value of money that you're able to achieve. So velocity of capital, that's a term that you'll also start to hear. And that's also affected by the waterfall. Okay, so some of you may have seen this chart before, but it's an important chart to just kind of wrap your mind around who the financiers are and how they get paid. So basically this column is different kinds of debt and equity. And then this is where they sit on the risk profile and on the priority profile. So senior debt is going to be in the lowest risk position and the highest priority position. And so let's just take a simple example. If you own a house, your own house, the company that holds your mortgage, they are the senior debt and you are the equity in that position. So your bank is in a low risk position, a high priority position. You have to pay your bank. And if you don't pay your bank, you might get foreclosed upon and you might lose your house. So they're the highest priority and they're the lowest risk, because if the market goes down and your house drops in value, like it did in 2007, 2008, then, and you need to sell the house, then they're going to get their money back before you get your money back. And so as an equity position, you're in a higher risk position. The bank always gets paid first, both as far as cash flow and as far as membership. Okay, so sometimes there's mezzanine debt. And what does that look like? Well, it could look like a number of different things. But for example, sometimes there will be private debt. So you can go into one of these syndications and be a private debt provider. So in that case, you might get, say, like a 7% return month over month, and maybe you'd get 1%, for example, like immediately, 1 point immediately upon execution, and then 7% until the debt is paid off. And so if you're in a debt position, you're getting paid after the senior debt, but before any of the equity. And so, that's going to come from cash flow, but it's also could potentially come from reserves. Sometimes people use private debt in order to close quickly on a property. And for example, just for an example, sometimes people will, and this isn't necessarily correlate, but sometimes if a sponsor wants to close quickly, they will not even worry about getting a major mortgage, and they'll get private debt. And then the private debt will be used to purchase the property. So they'll get private debt plus private equity. And then after 3 or 4 months, they will refinance and, maybe buy out the private debt. But maybe they won't buy all of it out for one reason or another. It just depends on the deal. So in any case, there's mezzanine debt, which is going to come after senior debt. And then after that, there's preferred equity and common equity. And so preferred equity basically gets paid before common equity. And that means that the preferred equity is going to be in a lower risk position, a higher priority, but they're also going to be not receiving as much of the upside of the deal, or potentially any of the upside of the deal. So, what's not on this is actually like potential rewards. So common equity has the greatest chance for having a large return on investment. Whereas senior debt, we're paying 3%, 4% on our senior debt these days. And whereas common equity is getting, obviously we're projecting 16, 18%. So that's a little bit about the capital stack. And sometimes there is a Another kind of, this is just, we're going to talk about a single tier equity stack. So in this case, the senior debt, we're going to have it at like a 70% loan to value. That's like a typical, I mean, I like to be between 65% and 75%. And why do I like to be in that range? Because on one hand, we like to use leverage, because leverage is how we make money in real estate. We're able to we're only paying the bank 3 or 4% interest, but then we get to capture all the appreciation on the entire value of the property. And so 65 to 75% is kind of the sweet spot for me personally under most circumstances. So that's not really related to the overall equity, but the equity class, common equity, sometimes we're going to split it, like 70-30 is a typical split. You might see 80-20, and you might see 50-50 sometimes. It just depends on the sponsor and how much work they're putting into the deal. If it's a heavier lift, you're going to see something closer to 50-50. And if it's a lighter lift, you're going to see something closer to 80-20. And that's 80% to the investors. And usually you'll see class B as the manager class. And so the manager is also called the sponsor, is also called the general partner. So general partner, manager, and sponsor are oftentimes in terms that are used interchangeably. And they're going to get approximately 30%, and they have a higher risk. So common equity class A is usually going to get paid before the general partner gets paid. And that's to create alignment of interest. And the way that we'll do that is, the way that we'll create this. So in this case, and there's a few different, there might be a blended return of common equity and preferred equity. Like I was saying, preferred equity gets paid before common equity. And so sometimes class A will have a preferred return. And so the preferred return is a form of preferred equity. And so the preferred return, we will pay out 7%, let's say, and that 7% will, you'll have to read the PPM, but, and ask the question, is it going to accumulate or is it not going to accumulate? Personally, I usually have the preferred return accumulate before doing the waterfall split. And so let's go to the next one, and it'll all start to make sense. So, okay. So in a typical situation, or not in a typical situation, but let's just look at an example. So in this situation, class A is going to get a 7% annual preferred return based on their original upside or their original investment. And they're not currently participating in the preferred, in the upside. So just to back up. So like this waterfall occurs after all the debt positions are paid. So before we get here, we've paid our senior debt, we've paid our mezzanine debt, and we've paid all the property expenses, and we've paid any fees like an asset management fee or a property management fee. And so now we have distributable cash flow. And so this distributable cash flow, this is how it's going to get distributed. So first, it's going to go to class A preferred equity. So 7% annualized preferred return based on original investment. And so the general partner isn't going to capture any of the distributable cash until the class A partners have gotten a cumulative amount of 7%. And so what does that mean? It means if we distributed 3% in year one, then in year two, we wouldn't be able to distribute anything to the general partners until they reached a total return of a 7% annualized. So let's say it was 3% in year one and then 10% in year two. At that point, we're only at 6.5% annualized, because 10 plus 3 is 13. So that's a 6.5% annualized. So we still have not gotten to a point where the general partner is going to partake in the upside. Then let's say in year three, there's another 10% that's of distributable cash flow that we can distribute. So at that point, We've got 3% plus 10% from year 2, and then 10% in year 3. So that's 23%. So 21% would be going to the limited partners, the Class A equity. And then there's only that extra 2%. That's going to be then split, that 70-30. If, in this example, it was a 70-30. And so 70% of that 20% is going to go to the investors, and 30% of that 2% is going to go to the general partners. So you can see this is quite skewed towards the limited partners. And that's on purpose, because we want to create alignment of interest. We don't want the sponsors to be getting compensated too much early on, because we really want the sponsors to deliver, and they need to be incentivized to deliver. And that's why we have this whole waterfall structure. But you have to make sure that you read the documents and that you know exactly what it is you're signing up for, because there are some nuances. For example, sometimes there'll be a GP catch up, which we're going to go over in just a minute. So repay any unreturned Class A capital, and then we'll make up anything in arrears to Class A. So that's like, that 10% I was talking about. We're making up anything that's still due. And any remaining distributable cash will go to Class B. In this case, in the case of a GP catch-up, we're going to go over that in a second. So yes, so in the case of a GP catch-up, so what a GP catch-up is when you catch up the GP to 30% total. So in a GP catch-up, the Class A investors will get their 7% annualized return. And then any cash flow is going to be split 70-30, with 70% going to Class A and 30% going to Class B. And so we're going to be then accumulating the GP cash up to 30%. So in the deals that I've done so far, we have not done a catch up. And then after the catch up, then it's split again, 70-30. So let's now, and then there's another kind of hurdle that you'll sometimes see, which is a 7-pref plus an IRR hurdle. So what does that mean? So that means that, and this usually probably won't happen until the property is sold. So once the property is sold, there's usually a large capital event, or it may happen at refinance, but let's just say it happens when the property is sold. So at this point, up until now, the limited partners have received a 7% preferred return, and the general partners and the limited partners have then split any remaining cash flow 70%, 30%. And at this point, then let's say we hit that 13% IRR. At that point, then any remaining cash is then split 50-50. And so why do we do that? We do that because sometimes the sponsor wants to get compensated for really overperforming on a deal. And if they know that there's like so much upside to the deal, they want to take part in the winnings in a 50-50 kind of way. And so that's another thing to look out for. Is there an IRR hurdle? And feel free to drop questions in the chat if you're having any types of questions. Okay, so now we're going to talk about a dual tier stack. So we just went over the single tier stack, and now we'll talk about a dual tier stack. So we have our senior debt. Okay, let's assume there's no equity, or there's no mezzanine debt. Then we have one type of preferred equity, which is the Class A equity. So sometimes you can have Class A equity that is getting a 9% or 10% preferred return, and they don't participate in any upside. So they're literally just getting, say, 9 or 10% preferred return for the life of the deal. And then when the deal sells, they still just get that 9 or 10%. They never get that huge payout at the end. Now, why would you do that? Well, some people want to do that because they like to be in this position where they're sitting right after the senior debt. It's a lower risk position in their eyes. And let's say they're focused on capital preservation. that's a great place to be in. If you're focused on capital preservation, just earning 9 or 10% on your money is a great place to sit. But if you're trying to grow your net worth, then you may prefer to sit in a slightly higher risk position, but then you will also, and you'll be at that point lower priority, but you also, this is where the kind of the big money gets made. And in this case, common equity class C is the general partners. So I think that's an important point. You'll start to see that more and more, where you can participate as a preferred equity partner, sit right after the senior debt and just get, 9 or 10%. And then you could also sit, what we usually do, most people are usually in the class B, and we would usually put a limit on the class A, because we can't have only preferred equity, because then that would be, we wouldn't be able to deliver on that necessarily, or that would put the property in a not the best position. So one thing you'll see is that you can do a blend of class A and class B, of preferred equity and common equity. And some people like to do that. Let's say they put $100,000 in. Some people like to have, $25,000 be preferred equity and $75,000 be common equity. And that's happening more and more, where people are allowing like a blended portfolio or a blended return profile. And it's the reason that we're doing this is because it allows investors with different priorities to all participate in the same opportunity. So if you're somebody who is more focused on capital preservation, like you already have accumulated a lot of wealth and you just kind of want to make sure your money is working for you and not losing value, then you would be interested in class A. But say you're like maybe someone who's younger and wants to continue to grow their nest egg and be a bit more aggressive, then you guys can both participate in this deals, because you can choose which class of equity you want to be in. And okay, so let's practice. So we kind of went over this a little bit, but in this case, the class A partnership, there's 9% to the preferred investor. And in class B, we've got a 7% preferred return to the investor, and then a 70-30 split thereafter. And in that case, we're also doing an IRR hurdle. So this is kind of what you want to look for, something that looks sort of like this in the OM, and that will give you a sense of how the proceeds are being split. And you also always want to read the PPM, because that's the bottom line. So once you look at this in the OM, then make sure you go to the PPM and make sure that it's reflected, and that you understand what's happening and that you understand how the money is flowing, because it's a critical piece of understanding these deals. Okay, so in this case, let's look at a timeline. So in this case, the investor has invested $1 million, and let's just look at the difference between a class A investor and a class B investor. So a class A investor is going to put in $1 million, and then in year one, they're going to sit right behind the preferred, right behind the senior debt. And so they've been, the agreement says 9% preferred equity. So they're going to get paid $90,000 every single year. And then in year 7, when the property sells, they're just still going to get that $90,000. So in this case, class B, the investor is getting, let's say it was 4.4% in year 1. And that's because they're getting the distributable cash flow that's left after the preferred equity gets paid 9%. So after the preferred equity gets paid, then next, the class B investors are going to get paid, and they're going to get paid 4%, and then 7% and 7.8%. And at some point, if the returns get higher, then they might, and they get to their, like if this was a 7% preferred return. So in year 8, it starts to go above year 3. See, it's above 7%, because we have to catch up for what we missed in year 1. And so in the end, this partner is going to get 1.642 million. And they're going to participate in the big upside of the deal. So it's, of course, always important to add up, how much you're getting paid during the life of the deal and how much you get. So I actually add this up. So that's like 43,500 plus 70 plus 77,500 plus 7,500 plus 77,700 plus 83,500 plus 642,200. So they're getting quite a bit more, like almost $300,000 more, I think, than the Class A equity. And so what is your priorities? You know, are you in a period of growth? Are you in a period of capitalization? And how much risk are you willing to take, right? Like if you're just someone who's extremely risk averse, maybe you want to just sit in Class A because you just feel better. And maybe that's actually a good place to start if you're getting comfortable with these types of deals. Now, of course, these different class shares are not always, we're not always offering them, but I wanted to break them down so you could kind of get a sense of the range of options that are available. And if you are interested in a preferred equity position, like getting just 9 or 10% every year, then please let me know, because I would be very interested to, I'm not currently considering doing that, but other people are doing it. And it's something that we're definitely going to be implementing at some point. I just don't know when. So that is a primer on the capital stack. It's a lot of dense information, and I don't know how clearly it was communicated. So I want to just open it up to questions and see if anybody, if you guys grasped what I was saying, if there was anything that was unclear, please let me know.
Could you just do me a favor and go back to the, trying to think which slide it was. It was the first slide where you were breaking down debt equity, and it was the one of the slides where you had it written out. After that one,
written out.
Okay, yeah, I think, let me see if it was this one. No, go back to the last one. Where it says Class B gets all, oh, okay, I get it. Class B gets all the profits past 7% preferred return. It's because A's got the 7%. B gets past the 7. In this case, does B have a set preferred? It's saying that B gets all of it. Then when does the 70-30 kick in?
Well, in this case, it kicks in usually on sale. So because usually they're not going to catch up enough during the life of the hold period. And so then the 70-30 split would kick in usually at sale. And so,
okay.
Yeah.
So you're assuming that Class B is not getting their 7%. And that's why it's reading all profits go to Class B.
Yes, exactly. Yes, that is correct.
Yeah, okay.
Because typically it might happen. And so, I mean, I should just say until caught up. So yes, so basically it's not just usually, sorry, that's not clear. So the remaining distributable cash gets distributed to Class B until they are caught up to their particular situation. So
whatever their level is. Okay.
Yeah. And so, so for example, like when I was talking about the GP catch up, so in that case, it would be that that Class B would get caught up until they had also gotten to a 7% preferred return. And then at that point, then they would go into the 70-30 split.
Got it.
Okay. Thanks for asking that. Okay. So Lynn asked a question, is the Class A debt Great question. Class A is not debt. Class A is also equity and also will have K1s and also will partake in the losses. So let's see where I have this written out somewhere. I should have it written out somewhere. Okay. So here's an example. So actually, I'm just going to go to this one. So in this case, Lynn, the senior debt is debt. The mezzanine debt is debt. And then class A preferred equity is equities. And then class B equity is also equity. And all of these groups will participate in, will all get K1s because they're owners. And so we are partners with the general partner. We're all partnering together to make money and have a good time. And so we're not an expense to the fund. We are owners of the fund or the property, and we're going to be participating as if we own the building, because we do from a legal standpoint. The preferred part comes in as like, well, there's preferred equity and then there's common equity. And so the preferred equity just sits in a different position in the waterfall than the common equity, but we're all equity owners and we're all going to get K1s and depreciation. Was anything unclear? Was anything else unclear? This is the first time I'm like attempting to explain it. So I just want to make sure that it was understood. Okay. Well, what would be helpful to go over next? I think next week I'm going to go over fees because we haven't done that yet. And that is important for people to understand how the general partners are getting compensated and how fund managers are getting compensated. So we're going to go over that next week. But yeah, if no one else have any questions, then okay, I hope this was helpful. Was it helpful, Jennifer? Was it helpful for you? Yeah. Okay.
Yes.
Awesome. All right. Well, let's talk next week. And thank you everyone for coming on. And we'll talk to you later. And Jennifer, I will send you a link and we'll we'll hook up right after this.
Okay.
Okay. Thanks everybody. Bye.